The markets are off their summer lows, but some investors wonder, is another pullback coming? Joining me now, RBC Capital Markets Head of U.S. Equity Strategy, Lori Calvasina. Lori, thanks for coming on the show. Really appreciate it. So as I was saying, one of the big questions is, was June the low in the market, or are we still waiting for that in the second half? Well, what indicators do you look at to try to make that call?
So look, I've edged more into the camp recently that June probably was the low, but I would say that's more of a 60% probability in my mind. I think there is a good chance we're going to have some additional volatility between now and year end. I've been telling investors that I think the earnings outlook is still somewhat cloudy. I think it's really, frankly, too early to have visibility on 2023 and where the economy is headed. I think conference season after Labor Day, companies are going to start potentially either relieving investors, making them comfortable about the outlook for next year, or giving them additional things to worry about.
So that's an interesting point, because when you hear portfolio managers talk about how they're going to outperform the market, one thing you never hear is, well, we like to buy lousy companies with no earnings. But you've been following the so-called low-quality trade, and you say that's actually where the winners have been recently.
Right. If you look within the Russell 1000, which is a good gauge of mid and large cap stocks, we've started to see negative earners, low ROE stocks, and also smaller market caps start to outperform really just over the past 4 or 5 weeks. We've been seeing that happening within the Russell 2000 since June. So the junk is starting to run off the bottom, as they say. This is typically what we see coming off of a bottom in the middle of recession. Investors hate it. They do not typically have enough exposure to that part of the market, understandably so. I'm not telling people to go out and have a massive low-quality portfolio, but that is really the pain trade in the market right now. But it is normal if we did see the low in June.
So how should an investor play that?
So look, I think that if you really want to play it over the short term, I think you can look at some of the sectors and some of the industries where the earnings Band-Aid has been ripped off, so to speak. So if you look within small cap or within large cap, frankly, specialty retailers, the rate of upward revisions, a good gauge of earnings sentiment, is basically at historical lows, at a level where basically nobody is taking numbers up. So you can sort of look for potential reversions in that sense.
Okay. Now, you mentioned small caps. That has not been a great trade, but maybe some opportunities there?
So what we've seen since January is small cap is holding steady relative to large cap. Small caps also do tend to outperform coming off of the mid-recession bottom. They basically got down to trough valuations. They're trading like ISM has already plunged and fallen to typical troughs, and they're already baking in a big spike in jobless claims. So if you're worried about recession with a capital R, I think it's basically baked into the small caps, and you can go ahead and buy those for an eventual recovery whenever that is.
It's fascinating. From an economic perspective, we're saying, are we in recession? Could there be one in our future? And the market's already moved past that and said, okay, this is the out of recession trade.
Right. And look, I think most investors and even a lot of companies are saying if we have a recession, it will be short, shallow, technical, largely play out this year. The market fell about 24% at the mid-June lows, and that's very, very close to a median recession drawdown. So if that short, shallow, technical recession thesis is right, you paid the price for it already in June.
So another factor here that you've been tracking is that gas prices obviously elevated but have pulled back, and you say you've already seen that in consumer behavior.
Well, we've seen a few of the retailers, a few of the consumer companies, especially in the small cap space, actually say, look, things were, kind of slowing down in June, but when gas prices were still high, and when the gas prices started to come down in July, things got a little bit better. Now, I want to be clear, there's still a tremendous amount of concern about the consumer, but that is something we were starting to hear from a few companies.
Okay, one more question for you. It is never, in my opinion, a good idea to invest based on politics. If you got out of the market because you hated Obama, you hated Trump, not a good call in either direction. But we got midterms coming up. It had looked like a total red wave. Now there's some more questions coming in. How are you thinking about that as an investor?
So I still think at the end of the day, there's a good chance the Republicans are going to take back at least the House.
Certainly,
I think the Senate is more questionable, and that should be good enough for markets longer term. If you look at the sort of different political backdrops and how stocks perform in them, a Republican sort of controlling everything, very, very strong backdrop. But if you have a Democratic president and either a split or Republican-led Congress, that gives you a similar return backdrop. So I think even if Republicans manage to take one chamber, it's good enough. But I do think that has been a very, very consensus part of the market. I heard people talking about the red wave back in June as being a reason to buy stocks. So I think what you're seeing in the betting markets, some doubts emerging about the Senate, Biden's approval numbers starting to stabilize as gas prices have come down. I think this is going to be something markets could potentially worry about and sell off a little bit on, frankly, over coming months.
Yeah, markets love a split Congress and president. Thank you so much, Lori. Great to see you as always.